Welcome to Pathway to Property, your go-to podcast for building a property portfolio and breaking down property markets.
Hi everyone, my name's Lachlan Vidler. I'm the Director of Atlas Property Group, and I'm here to welcome you to the first episode of the Pathway to Property podcast. I'm very excited to be here with my co-host, Luke Clifford. Luke, how are you going, mate?
I'm doing well, mate. I'm doing well. It's a Thursday. We're getting closer and closer to the end of the week, which is always a good thing.
I don't know if I should be happy that you say that since Luke works very closely with me at Atlas Property Group, and Luke has decided to jump in with me, take all that knowledge that he has accumulated over the years of property investing and also working with myself and our clients. So, mate, I don't know if I should be happy that you count down to the end of the week or not. Should I give you a pass?
I think you should, mate. I think a little bit of leniency would be nice.
Well, everyone, we're really excited to be here. As I said, the podcast is called Pathway to Property, and we've got lots and lots to talk to you about. Now, before we go through and tell you what the podcast is going to be all about, I thought it would be really good to introduce myself and Luke to introduce himself so you know who we are, why we're here, and why we love property so much. So, as I've mentioned a few times, my name is Lachlan Vidler, and I'm the Director of Atlas Property Group. Now, we love doing work with Momentum Media, and some of you may have heard me on the Smart Property Investment Show over the years, as well as some of the other podcasts and media that I do. But for me, my story actually starts back as an 18-year-old when I finished school and I went off and I joined the Navy. So I was in the Navy for about 6 years. I joined as an officer and I spent time as both a warfare officer and a logistics officer. But probably most importantly, I got to learn a lot of really cool skills. I got to see the world and I got to really mature and decide what I wanted to do and what I didn't want to do. Now, when I reached the point, as we all do at some point, of deciding that I wanted to move into my next challenge, I left the Navy and I went and worked in the corporate consulting world where I worked for Deloitte and Accenture, working on consulting contracts and really learning the business side of leadership and of management, and then also a lot of the do's and the don'ts of how to improve and run a business and everything of that nature. Now, over that whole journey, I'd been a property investor myself. So I bought my first property, it was either 22 or 23, and then from there, I fell in love. I absolutely fell in love with property investing. So as I was working in corporate consulting, I very quickly realized that my passion lay with property. And I thought, you know what? I think that I can go out and I could see a bit of a gap in the market. And I think that I could maybe start a buyer's agency and really plug that gap. So past the career side, what I really wanted to do and bring in was a really strong educational background. So I'd done a business undergraduate degree, I'd done a finance master's degree, and I'd done property at the master's level as well. So what I saw was a big gap in the market where there was a lot of buyer's agents out. Actually, there really wasn't that many buyer's agents when I started. I started Atlas better part of 5 years ago. There wasn't actually that many buyer's agents out there, but the ones that were, what I saw was a big gap with people that had a really strong educational background, really strong analytical background, but also who could take complex ideas and simplify it down so that for the mums and dads and regular people that I was wanting to help, I could take those advanced and complex ideas and make them easy to understand and then obviously help them grow and start a portfolio. So with that in mind, I then started Atlas Property Group, and Atlas Property Group is an investment-only buyer's agency. We're based here in Sydney, but we work nationally, and our big specialty is bringing people in at the start or early into their portfolio and then helping them build and scale a portfolio to help them towards retirement. Now, it's not just about early-stage investors. We have people from all walks of life. We've got people who are, I think our oldest client we had was about 70-odd. We've got people who have got, over 10 properties in their portfolio, and then we've got people who are, in their early 20s or early career, and they've got nothing. So past all that, that's a good bit of background on me. I think the other two things I just love to talk about is I've also worked as an academic at the University of New South Wales, which I think really just solidifies that analytical, critical thinking capacity that we then take forward into all of our clients. And I also sit on the largest property investing board in the country for professionals, which is the Property Investment Professionals of Australia. So we've got, I think, the better part of 500 members now across both individuals and corporate. So for me, ethics are so important. So that
Wow.
is.
Wow, there you go, folks. There you go.
You're looking at me the whole time counting down. I could see
I'm
it.
thinking, how am I supposed to follow on from this? Wow.
Well, mate, you've got your own really interesting background, right? Obviously, I took my path, and I really sort of decided to not sleep a lot and really get out there and try a few different things. But mate, you got a really interesting background. That's why I loved it when we first worked together. Why don't you tell everyone a little bit about yourself?
Yeah, for sure. I think first of all, really excited, really pumped to be co-hosting with you. I think for some of our listeners, this is obviously the very, very start of their journey. And for others, they might be a little bit further on in their portfolio building journey. But I think we can all agree that buying property is arguably the most important thing that you could do with your life in terms of trying to set yourself up, set your future up. So I know a lot of people kind of harp on about, stripping emotion out of the equation when it comes to investing. And we believe in that as well. But I also believe that when it comes to building that knowledge base, why not bring some fun and excitement into the mix as well? So I'm really excited to be offering that fresh approach with our show. A little bit about me. So I'm a property investor. I'm actually an ex-professional athlete as well. So you can expect to hear.
Are you, mate? Are you?
A little bit.
Tell us, what were you an athlete in?
Yeah, so soccer. I played soccer since I was 4 years old.
Yeah.
And I was lucky enough to actually play in the A-League. So I was at Sydney FC for a couple of years.
Yeah.
Unfortunately, had a couple of hiccups along the way with injuries and stuff like that. But then from there, property was really my calling. So I think you can really expect to kind of get those sporting analogies out of me throughout those episodes. And, Lockie and I, we've been working for 2 to 3 years now together. And, mate, I'd have to say, pulling me into the mix would have to be probably one of the most intelligent things you've done. What do you think about that?
It sounds like the kind of speech you hear at a wedding where it's it's somebody talking about the bride or the groom. But no, mate, I got a lot of love for you. I think I've seen your growth, personally and professionally, and that was why I was so excited to have you join me as the co-host on this show, because I think you've just got such a wealth of knowledge. Now, I've got to say, right, you talk about being a professional athlete, you talk about how, one too many injuries. Now, is it like all of us where, we could have made it? We could have made it if it wasn't the bad knee,
Of course. You hear the Cristianos, the Messis of the world, mate.
Yeah.
I would have been right up there with
you
them.
reckon?
For sure.
Yeah, the next Timmy Cahill.
Absolutely. But, mate, I think how about we kick things off?
Yeah.
Like, let's get it started, kick into gear. How about you kind of share with the listeners what this first episode is going to be about, and also what the show is going to be about as well?
Well, I'll start with where the show's at, because I think it's it's our first episode. I know I've done a lot of episodes on the Smart Property Investment Network over the years, but this is now our show, right? This is a show for us to come on and really take control of the narrative and be able to tell a really consistent story about education, different things, rather than where in previous episodes where I do it with Smart Property Investment, I might be on 1 month, might not be back for 6, and things change. So I'm really excited from that point of view, because we get to take control of that narrative and really help people out. So for me, and for anyone who might be watching along with the video, we got some good notes here, because I think it was really important, especially for this first episode. We wanted to just make sure we're crystal clear on everything for everyone, so that you know what to expect. And I think the name Pathway to Property is a really good indication of sort of the kinds of things that we are going to be talking about. But for me, the reason why we chose Pathway to Property is because ultimately we want to help educate everyday people on how to navigate the property market. And when I say everyday people, I mean, we all sit back and you read the news articles and you see that person that might have like 40 properties, or someone that's, really successful in business and they're worth a lot of money and they're investing, they're just kind of buying anything you see. And that's not to say that people in that boat aren't going to get something out of this, because I think they will. I think we're going to cover a lot of really cool things. I'll talk about a few more of them in a second. But this is really about trying to help those people who maybe you haven't started yet. Maybe you got a few properties under your belt and they haven't gone the way you wanted, or maybe you now don't have the time to do it. Maybe your family life's changed, your professional life, and we want to take you on that pathway to property and to property success. So that's that education element to it. And we also then want to help people learn and teach them about how to build and then scale a property portfolio. Because, man, let's call a spade, right? You can't buy 1 or 2 properties and then retire off them, right? It can't happen, especially when we think about how, difficult the world is becoming these days. Cost of living is going up. and it's only going to keep getting worse and worse and worse. So we want to help people, and we're going to bring in that knowledge about how to build and then scale out a property portfolio. And then on top of all that, this is the third really key element of the show, we're going to analyze and discuss property market trends and performance of markets all across the country. Because at Atlas, we buy all across the country. We buy in different markets for different clients depending on where they're at and what they need in their portfolio. So we want to bring in that really analytical element so that for people listening in, and I will say, it's not going to be this episode. I'll talk about this episode in a sec, but we're going to break down markets. We're going to talk about how you analyze markets. We're going to give everyone the tools that, while we'd love people to come work with us, over at Atlas, it's not about that.
It's about empowering them.
Exactly. Could not have said that better myself, right? I couldn't have said that better.
I'd chime in there. Yeah.
But you're right. It is about that empowerment so that if you listen in and then you keep listening in, you're going to get that confidence to be able to invest. Or maybe you get through it and you realize, you know what? I want to let professionals take the wheel. And that's okay too. But I've said it since the first client we took on. An informed client is a way better client. So whether you're doing it yourself or you're getting help, that's what the whole purpose is. So that's what we're going to be doing.
Exciting stuff.
Yeah.
Yep. So in terms of this episode, I think we're getting straight to the start of it all. And we're going to be talking about the importance of, goal setting and why goal setting at the start is non-negotiable. And, if you've got one or two properties under your belt and you've kind of, shot from the hip and you've done okay, but you haven't really had that roadmap on how to get to where you want to get to, that end goal, I think this episode's really for you as well. I guess throwing it to you, Lockie, like what do you kind of see with people and what do you think are, I guess, those really important factors when it comes to setting goals for yourself?
Well, I think the first thing I want to say is for anyone who might think that this episode is going to be a little bit boring, I promise you it's not going to be boring whatsoever. I know goal setting might not sound like the sexiest thing to bring into it, but like you said, Lukey, for the first episode, we want to start at the bottom, right? Which is that nobody buys property just to say, I'm a property investor, right? Everyone does it for a purpose, and that purpose then underpins what your goals might be. So for everyone listening, I promise we're going to make it nice and fun and exciting. I'm sure Luke's going to throw out some just cringeworthy sports metaphors and analogies, and I'll be jumping in and putting my own ones in there. But it's so important. I'm so excited to talk about this because I think it gets lost a lot. So you asked me what I see. What I see is people don't understand, or maybe it's not even understand. Maybe it's people struggle to articulate why it is that they want to invest. Because and tell me if you agree with this, right? Because you talk with so many of our clients or prospective clients every day. The issue is that they might, in the back of their mind, kind of know why, but they struggle to articulate it, and it means that they often go out and make poor decisions because they don't understand the why behind it. What do you think?
I would agree with you, and I think probably another big reason is with property is inherently a long-term asset class, and I think when people think about, setting a goal, a 5, 10, 15, 20-year goal, because it's so far in the future, sometimes it feels so intangible that is there really a point to doing that? But what I would say to those kind of people is if you don't have at least an initial flag in the sand as to where you think you want to end up, how can you possibly work backwards and understand what's going to be required from your portfolio to get you there in the most efficient way possible, right? And in saying that, that flag in the sand that you establish doesn't have to be the be-all and end-all, right? That flag can shift forwards, backwards, side to side. And, it's subject to change because, our personal circumstances and financial circumstances evolve as time goes on.
Yeah.
But it gives us a starting point, and then we can constantly review and adjust that plan as we go along. What do you think?
Yeah, I totally agree. And you know what we didn't say? We didn't actually say what you do at Atlas, right? So Luke is the senior investment consultant at Atlas. So he talks with clients and potential clients for us every single day, right? You're probably chatting with 20 to 30 people a day, right? So I think you're a really good person to have in this conversation with me because you know exactly what those goals or those issues that come about from either not having them or misset goals. I think if I was going to sum up what you said and like the way I kind of think about it is, if you don't have the goals and you don't understand the purpose, and you don't understand the intent, you are really just flying blind. You're flying blind because you might make an awesome purchase, right? You could make an awesome purchase, but it could be a really bad purchase for where you're at. You could be a really bad purchase for helping you get to where you want to be, right? So what could be an awesome purchase for somebody else might be a terrible, terrible purchase for you or for another person.
Yeah,
So
couldn't agree more. And I think something that we commonly see, like we get a lot of inquiries all day, every day, and people jump on the phones and all they want is cash flow positive properties, things like that. But it's really about understanding what their situation is and where they want to get to. Because sure, you could get into a property that, you know, has a really strong rental yield. You're trying to combat that interest rate, so you're not so much out of pocket. But at the end of the day, if you're not so much out of pocket, or maybe even putting 50 to $100 in your pocket every week, but you're not achieving a beneficial level of capital growth to help project you into that next opportunity, are you really going to be happy with that level of performance?
And you know what? I reckon the best thing I can say to that is it depends, right? Because for one person, that might actually be the stage that they're at. For most other people, it might not be. And I think that's, again, why having those goals understood and set is so critical, because otherwise, like I said before, right, what is an awesome buy for someone else might be terrible for you, and what's an awesome buy for you might be terrible for somebody else. So I think ultimately by doing this and by talking about goals and by understanding where you need to get to and what you need to be doing, and I think linking into the overall purpose of this podcast as well, what we want to be doing is we want to be, you know, I said part of it is helping people build and scale a portfolio. If you can set goals and understand where you want to be, and then obviously through this podcast, we want to get you into the top 10% of investors, right? Which are people who own 3 or more properties. And I reckon from all the people that I've ever seen and worked with, the biggest thing that stops them from being able to get into that top 10% of investors is the fact that they didn't set their goals, which meant they didn't know what the right thing to buy was, which meant they bought something that might not have been terrible, but it wasn't good for them. And then suddenly
They get stuck.
they're stuck. Exactly right. You know, they're stuck. And I'm thinking about, we won't say any client names or anything on here, but I'm thinking about the guy. He actually didn't end up working with us. You remember he had a whole bunch of units. He had a whole bunch of units in Sydney.
Yeah.
And he'd bought them, I think, in like the early 2000s, and he was getting a little bit of cash flow from them. He was a very high income earner, and he was getting a bit of income from them. But the issue was that he owned like 4 or 5 of them. Yep, they've gone up in value a little bit over the years. First issue was he bought units in a very, you know, dense area in Sydney, which meant that the values, whilst they've gone up, not as strong as they could have been. But the biggest issue was for him, he because the properties didn't grow, he then struggled to keep scaling, and he owned like 4 or 5. So technically, he was in that top 10%. But I can tell you that they weren't the highest quality of asset. And I remember when we spoke with him, I was talking to him. I was saying, mate, like, you know, we've got to rebalance this, because what you want to be, what your purpose of your portfolio is versus the assets you've got in it right now, there is a huge mismatch. Huge mismatch, right?
Yeah.
So, but I think for most people on a more, you know, simple level, you go buy one property. You go buy, maybe it's where you live next door or something like that. It's a good area. You go drop, you know, $1 million or something, $1.5 million on it, and you do it because like you think you know the area, and suddenly you don't buy another property for 10 years because you can't afford it, and it's because you didn't buy the right property because of your goals.
Yeah,
you know.
Yeah, absolutely. And I think there's this common misconception that people think that they can just buy anywhere, and if they hold that property long enough, they're going to do well, right? But that's not what property investing is. It's not about, you know, playing the waiting game. It's about how can we get that growth at the front end of a 10-year period as opposed to the middle end or back end and really set ourselves up, right? So,
I agree.
But I think something that I often see a lot of clients struggle with is actually figuring out how they actually set realistic goals for themselves. Because it's all well and good to say, like, let's set some goals for ourselves.
Yeah.
But you'll get people that will just say, well, why don't I just shoot for the moon?
Yeah.
And if I fall short, I'm going to be okay.
Yeah.
Right. So why do you think it's important to try to set specific, realistic goals for yourself? And how do you do that?
Yeah. So I think that the reason it's important is because you need to have something to measure you against, right? Like, there's no point just saying, I'm going to buy a property, or I'm going to do this, or I'm going to do that. Like, and you can apply it to any part of your life if you don't have something to measure it against, because you're not going to know if you're on track, ahead of track, behind track. You need something there. So I think that, to me, that's the most critical reason of the why. Yep. But then how do you do it? That's a good question. And when we're planning out what we're going to chat about, I think what we really broke it down to was, you know, I think that there's probably a good kind of five steps, 5 probably key steps that we go through. So for me, the first one is, and some of this stuff we've kind of already been talking about, right? But for me, the first step is you have to find your why. You have to find your why. The why, and look, I'm sure there's somebody out there who will say, oh, this is my why, but I don't really think that if you get deep below the surface, it is. The why isn't to own 10 properties. The why isn't to own 50 properties. The why is not to own 5 properties or 2 properties.
It's what those properties are actually doing for you.
Exactly right. So you have to find your why. Now, what are some of the most common ones I hear? I hear, you want financial freedom. And what I hear when I hear that is, it's like a good catch-all term, but to me, that is more about choice. People want the choice. Do I work? Do I not? Do I work 3 days or do I work 5 days? Do I work in a job that I love and it's more passion, or do I work in a job that pays me a lot of money because I have to do it to support my family, right? But I guess financial freedom is a bit of that. I hear, your why might be to set up your family, like your kids. Like that's a really common one, I think. Yeah. And tell me if you agree. I think we're having a lot of conversations, especially over the last few years, where prices and values continue to increase very rapidly. And to me, and we'll do episodes on this very shortly. I think our next episode might actually be diving into some of this. That's going to stick around for a while. We've got really significant supply and demand imbalances, but setting their kids up because they see how hard it's been for them, and then thinking about, if my kids are 5 or even 10 years old right now, where's it going to be in 10, 15, 20 years when they're trying to get on the ladder? Unattainable. Right?
Yeah. So I think it's one thing, wanting to do well and provide for your family and build a little bit of a nest egg for yourself. But there's another approach where you're looking at things analytically, you're looking at data, you're making educated decisions as opposed to just, basing your decision-making off an opinion, right? Or something that
Couldn't agree more. Yeah. So I'm trying to think, what other ones we hear? So we got, they want that freedom, and obviously said how that can break down, setting up your family. I'm trying to think what other ones we, really, can you think of any other really common ones that we hear? So I feel like that financial freedom one, which when you break it down really just comes into that choice. I feel like that is kind of it for most people.
Yeah, I think at the end of the day, most people are wanting to build out a portfolio that at some point or another is wanting to supplement their lifestyle or maybe even replace their current income.
Yeah.
And then on the flip side to that, you got the other people that are, wanting to build that equity base, really focus on that wealth building component of it.
Yeah. No, I agree. Well, I guess getting back, right? Step one, it's find your why. And I think for everyone, it's really important to think about that. And I think as well, it's important when you're thinking about your why, and I'm going to talk about this, I guess, in step 2, so it's probably a good segue, is it's also important to understand that there is a time commitment to this, right? And your why might be, I want to be more comfortable today. Oh, sorry, let me rephrase. Your why might be, I want to be more comfortable. And of course, if you ask anybody, when do you want it? Everyone says, I want it today, right? Yeah. But it's important to understand that depending on where you start from and where you want to go to and everything that then has to transpire in the middle of that, the why might be to have that, but it might not be necessarily actionable today. But by understanding and really embracing that core why, it is going to give you that motivation to get up for work the next day, to get up for work in winter when it's cold. You've been up late working that night before. You understand that why is driving you, and it might take 5, 10, 15, 20 years to get there, but it keeps you moving, right? Which links into step 2, which is setting a timeline and a target, right? Yeah. So you now know your why. Now you need to go, well, how long do I want for that? And what does success look like?
Yeah. How do we actually quantify that
Exactly
goal,
right. How do we quantify that?
And this is probably the component that I think most people struggle with.
Yeah.
Right? It's really, how do I put a figure on it? Right? If I'm on 100,000 per year, like what kind of timeline am I looking at? Like what kind of passive income level is realistic based on my current situation right now? Right?
Yeah. I agree.
And I think that is something that a lot of people get discouraged about, setting goals and building out plans because they're like, well, things are going to be changing. Like if I set this goal now, like it's just not going to be relevant in 12 months time or 24 months time. But I think the thing to stress to people is with any kind of plan, for it to be an actual successful plan, you need to review and you need to adjust that plan according to your situation, right?
Yeah, I agree. And I think the biggest thing that people need to remember with property, when we talk about the timeline side, is property is a long-term asset, right? It doesn't mean you can't get results in the short term, right? And that's something that we love to do for our clients. Yeah. So what is it? We average about 20% capital growth in the first 12 months, right? So like you can do it, but the point is that the asset isn't typically built to do that, right? Like you have to be very good at what you do, and having expectations of that is also misset, because the real power of property is time and leverage. So understanding that your timeline, whilst everyone's is as quick as possible, for most people to build out, especially if you're just if you're a regular everyday person, you know, you got a good solid income, you know, maybe you've got a family, maybe you don't, maybe you're a bit younger, so you know your maximum earning potential. But if we exclude, you know, super high income earners or people that might have come into money or just have some sort of circumstance that is outside the norm, for most people to even get themselves towards like 100K of passive income in today's dollars, it's going to take you 15 to 20 years for most people, right? Now, of course, in 15 or 20 years, that 100K today is going to look like, you know, more. It might be 180K, it might be 190, whatever it is, right? It doesn't matter. But the point is that it's going to take time to build that out, right? And then your target is going to then also dictate your time frame, because it's not linear. So like let's say that you wanted to try and build out 100K over the next 20 years. Success isn't necessarily that at 10 years you're at 50K.
Yeah.
Right? You might be like at 10K at 10 years, because that's the thing about investing in almost anything, definitely property, but anything, is it's exponential. So as time goes on, your rate of the return that you get increases and it picks up. So and it's something that I feel like we talk to a lot of people about is we actually I don't know if you know this one, but we actually have somebody with us right now who I think I actually have a meeting later today with one of our portfolio strategists about how we're going to help this person out. But they had a goal of 200K in about 20 years. I think it was 200K in 20 years. And then we bought the first property for him. It's done incredibly well. In 6 months, I think we're up about 60, 70K in 6 months, maybe a little bit more, which I think translates into like a 15% capital gain on the purchase price of the asset. But anyway, long story short is he's now come back. He's ready to go for his second one with us. And he's come back and he said, I know that I wanted 200K in 20 years, but let's just change that to 100K in 10. And right now we're just going through this conversation with him to help him, like, you know, to educate him, right? Because he doesn't know, he doesn't play in this space all the time. Just to educate him that it's not as simple as going, oh, my timeline target was this, I'm now going to adjust that. I'm going to do it by the same thing. If I cut half the time, I can then cut half the goal. So that's good. I think that's a conversation I'm literally having later today, internally before we have a chat with him. But long story short, it's critical for everyone to understand that and remember it, right?
Yeah,
critical.
And I guess kind of pulling it back a little bit, just to go back to, I guess, setting those, I guess, quantifiable financial targets and setting that timeline for ourselves as well. What kind of things do you have to look at an individual level to try to figure out what those are going to be?
Well, I think the most important thing is you have to. It's a great question, by the way, mate. Great question. I think the first and most important thing, which is the third step after you've got your timeline and your target, is you have to go and break down your financial starting point, because everybody is different, right? The hardest thing for pretty much anybody, right, is your ability to borrow, right? That's always going to be your most difficult thing. You know, you can have lots of equity. You might even have stacks of cash, right? Yeah. We'll exclude saying, you know, you got $1 million of cash or something like that, you know. But you might have $300,000-$400,000 of cash, something like that, which is quite a lot of money for a lot of people. Or you might have hundreds of thousands, if not millions of dollars of equity. But if you can't borrow it, or you can't borrow, it's sort of not really relevant. So with the most important thing being knowing and understanding your financial start point, that's going to help you to understand your timeline, your goals. Because realistically, if right now, and we'll take a very, you know, vanilla situation here, if you've got a couple, right, and they earn, let's say they earn 100K each, right, which 10 years ago is a pretty solid amount of money. These days to earn 100K, like, you're still doing better than most, of course, but it's not a crazy amount like it was. So you've now got a 200K household income. With where rates are at right now, and, you know, difficulties in borrowing and assessment rates and things like that, maybe they could borrow, you know, 1 to sort of 1.2 million, which sounds like a lot of money, but that might get you 2 properties, you know, 2 decent properties if you've got the cash there. So for them to go and set a goal in 15 years of, I want to, 200K passive income, I'm not saying you can't do it. And there are obviously little tricks and tips, tongue-tied there, tricks and tips you can do and things like that to kind of maybe put yourself in a position to be like that.
Yeah.
The reality is, for the vast majority of people, that financial start point is too low to probably get them there, right? 200K in today's dollars, right?
Yeah.
Not 200K in the future. But then if you've got somebody else that earns 350,000 and they've got 300 or 400K of cash to start with, and you can go out and you can buy, 2 or 3 or 4 properties straight away, and they've then got a 15 or 20 year timeline, it's now very different. So to be able to set your timeline target, it's so maybe we actually even need to reverse that, right? So maybe step 2 is actually know your financial start point, and then step 3 is the timeline and target. But the point is, you got to do both because they work hand in hand with each other.
Yeah, couldn't agree more. And then I think a lot of people are kind of faced with this dilemma, whether they should really be focusing on, a cash flow focused asset or a growth focused asset.
Yeah.
I know that we take a positively geared approach towards property investing.
When we can.
Of course, we're obviously in a very high interest rate environment relative to where we were 12, 18 months ago with the 2% days. But I think where I'm just seeing a lot of people kind of make the mistake is they're going out there into particular markets, selecting particular property types just purely to combat where interest rates are. And I don't think it's the smartest approach because, as I said before, you could be putting that money in your pocket, but if we're not getting that growth that we need to be able to pull that equity out and put it into the next one, it can slow us down, right?
Absolutely.
But then at the same token, people don't want to be, say, 20, 30, 40 grand out of pocket to hold the property, right?
Absolutely. And I think it's really important to understand that, like, to me, and I haven't really seen any empirical evidence to support this, and we have a lot of data at our fingertips. We've built out our own suburb research tech platform completely in-house. We've got over 450 million data points of every suburb in Australia for the last 20 years, right? I'm still yet to see empirical evidence that really supports the idea that there is a growth market. And I put that in inverted commas because the reality is if we exclude outliers in this, every suburb grows and every suburb plateaus, and a lot of suburbs will then have minor corrections if they've gone a little bit past it. But we do have some people that go, if we say to them, what's your sort of priority? Like, where do you want to lie? And they go, I really want to just focus on growth properties. It's a bit of a red herring because it doesn't really exist, like it's sort of, because markets cycle,
Yeah.
On the flip side, you then have cash flow, which you can measure immediately. So you can definitely define a cash flow based market. But I think getting to your point about people then choosing wrong assets, maybe it's try to combat interest rates or things like that, I think you hit the nail on the head because this is where you really have to either be very knowledgeable yourself on how to build and scale a portfolio, or if you aren't, very important to get help because at different times of your journey, you're going to need different types of properties. And if you start your very first property, we're going to go through an example very shortly on it. If you start your first property in a market where you're ripping maybe like a 9 or 10% yield and you're thinking, how good, like look at this money I'm bringing in, happy days. But then you have issues with that, which we'll talk about in the example. It's not going to help you over the next 15 to 20 years. So I think it's so important that you can understand that you need growth, you need cash flow. They might come at different points, but you have to understand that both have a really important part to play in your journey, right? And that's going to then fall into your goals, right? Because we're talking about how do you set those goals. You have to understand that at different points. And it probably goes to the example I was saying before that if your goal is 100K in 20 years, at 10, that doesn't mean you have 50. Like cash flow might be the overall end goal. And I'd say probably for like 99% of people, especially, clients that we work with. Yeah. The ultimate goal at the end is cash flow because that lets you have that freedom, it lets you step back from your job, lets you do all that. But anyway, I'm sort of rambling on a little bit.
But I know for a lot of our clients, for all of the clients that we build portfolio plans for, every single year we're getting in touch with them, we're going over their financial situation, we're understanding how things have evolved, and we're adjusting their plan and strategy accordingly, right? Because it's not like, it's not like what your situation looks like right now is going to be how things pan out over the next couple of years. Things are always going to be moving. And I think something that helps a lot of our clients is making sure that we break things up into milestones so they're actually tracking that they're going on the right trajectory.
Yeah, I love it, and I think that's the most like the one of the best sayings I ever got told. We'll see. I feel like I've said it to you, so we'll see if you remember it.
You love your sayings, mate.
How do you eat an elephant?
You haven't told me this one.
I've definitely told you this one. How do you eat an elephant? How do you eat an elephant?
Couldn't tell you.
One bite at a time. One bite at a time, right? Same thing for goals. Same thing for where you want to get to, right? Like you can't buy your fifth property until you bought your fourth, and you can't buy your fourth until you bought your first, right? So I think you've hit the nail on the head there. You want to break up the big goals, which is sort of the targets and the timelines, into smaller milestones. And like, we do it by having the portfolio building life cycle, right? At different stages of your journey, we're trying to do different things. And then when you move between the different stages of the portfolio life cycle, that's almost like your milestones, right? Like you get through the foundation, it looks like this. You get through acceleration, it looks like this, and so on and so forth. It keeps people motivated because you know what you're doing, right? It's like, okay, I'm not worried about the property I got to buy in 12 years. I'm super pumped for the property I got to buy in 2.5 years or 2 years, 18 months. I'm saving for that. I'm motivated, and then you do it. You get that hit of dopamine because you're buying the property. You feel like you're making headway, and it's so much easier to take a really big set of goals, a really big time frame, and chunk it down.
Yeah, no, couldn't agree more. I guess let's now kind of shift gears a little bit, and let's play out a few scenarios where we take someone who has a plan and has gone out and strategically executed on a purchase versus someone who doesn't have a plan, who has then purchased something that they just think looks good at face value that's right for them at the given time period.
Yeah, absolutely. Well, let's keep it nice and simple. I don't want our episodes to go on forever. You and I could talk for hours and hours and hours, right? So I don't want it to go on forever. But let's just break down two really, really simple examples, like you said. Okay, so we'll go scenario one with an investor without a plan, right? And I'm looking at my notes to make sure I don't say anything here, and we get all the angry emails with, oh no, you're wrong numbers and this and that, right? But so let's say a client buys a property in suburb X, suburb Y, whatever you want to call it, and they've done it because of the high cash flow, right? The area that they've bought into, it's got pretty poor property fundamentals, and because of that, we know that especially over the medium to longer term, it's going to restrict the growth in that asset, right? And it's probably going to do that in the shorter term too. Like even if the fundamentals, the shorter term fundamentals look sound, it's probably still not going to be performing as well as a market that is that little bit better, right? So, if I was going to chalk it up to something, maybe think about like your mining towns or something like that. That's the kind of thing that we're probably thinking about with something like that, right? So, a few years later, they've then saved as much as they can, but we also know it's pretty hard to save money for most people between, just going about life, try to have a few holidays, try to save a little bit, save for other things. Maybe you have a family that grows, wherever it might be. It can be hard to save. So then by the time they get to, the point where they should be making the next buy, they really don't have savings. And then probably most importantly, they haven't built out the equity that could have helped them leverage a lot faster, because property equity should grow faster, much faster than your ability to save, right? So that's kind of the scenario painted. We'll give you some numbers, right? So let's say they're probably around that maybe like 9% rental yield mark, because we said that we were going into a higher cash flow market. Now, if they bought a 600K property and it went up at about sort of 2.5 to 3%, right? You're talking about in 3 years' time, and that's 3 years is you probably want to be trying to buy, especially if this is your first property, you want to be trying to buy your next one within about 2 to 3 years at the latest, right? That probably's gone from 600K up to maybe like 640. 650K, right? So you made maybe like 45 to 50K, which that's okay, right? Like that's probably more than you've been able to save. It's not too bad. But what about somebody that has a plan, right? So now let's say you got somebody, an investor, very goals focused, right? They've gone through what we've talked about. They've understand what their journey needs to look like. They understand the timeframes that they should be trying to buy properties, but also that they could tangibly actually do it, because we can all say I want to buy 5 properties in 5 years, but that might not be doable, right? So you got to bring that back to a plan and go, how do we practically do it, right? So they go and buy a suburb, or in an area because it aligns with all that, and we know that it's got that sound to strong fundamentals there. So after a few years, right, same 600K property, but this time it's growing around say 6%, which I guess compared to our numbers, where I say like we do around 20 on average, very small. but very, very, much smaller than what we look at. But also it's probably at or maybe just behind the national average too. So we're not even talking about an insane example here. That property has gone from 600 to 715K in 3 years. So it's, you've developed so much more equity to set you up, right? So I hope everyone's still following along. I just got a couple more numbers I want to take you through, right? So let's now just compare the scenario. So you've got property one, right? You've gone there, you think it's sort of very cash flow orientated, and you're thinking that, okay, well, this is what I wanted it for. I didn't want to get hurt by the interest rate. So when we sort of run, our calculations in the background on this, taking into account operating costs, a mortgage against a 20% deposit, I'm making some estimates around there. You might make around 9K a year in cash flow, which is not crazy. Let's be real. Like, it's not that wild. And then when you add in some of that equity, you're talking about 74K, right? You're talking about maybe overall over that 3 years, you made about 74K with the cash flow and then also the equity, right?
Yeah.
Property two, though.
And just back on that, 74K after 3 years, still certainly not enough to get into a market where you're looking to spend upwards of $600,000.
100%, yeah. And you think about over that 3 years between the first purchase and the hypothetical second, market's going to move as well, right?
Absolutely.
So it's probably hard today to just buy a second one, let alone in 3 years' time, right? So that's probably one. Like I said, you're gonna make around sort of 70 to 75K, right? So with property one, long and the short of it is we're around that sort of 70, 74, 75K in sort of total return when we look at the cash flow that we were making on it. And then also, the capital growth, while limited, there's obviously still some there. So we're seeing there. So let's look at property number two, right? So property number two, a little bit more balanced. We're looking at it from the point of view of maybe like around a 5% type rental yield. Now, because of where rates are at, obviously property is a little bit expensive to hold right now. So when we look at it from that point of view, we're probably, we might lose anywhere from about, I don't know, maybe 8 to 10K a year. And I must say as well, all these numbers are before tax. So with property two, where you are going to lose a bit from the cash flow side, that actually drops a little bit because you get some of that tax refund. Yeah. And then on property number two, your return is going to drop a little bit because you're going to pay a little bit more tax, right? And I want to say tax is important. You got to pay it, right? If you're paying tax, it means you're making money. So I'm definitely not saying property two is a better scenario because of tax benefits or anything like that, but it would actually bring it down a little bit just from if we're playing both sides of the coin, right? So losing about sort of 8 to 10K a year, right? And we're looking over that 3 year window. So when we add all that up, we're actually going to be then sitting around, if we made about 115K on the capital growth, losing a little bit each year from the cash flow, we're probably sitting around that 90K mark in terms of total gain, right? So you've got property two, you're making about 90K. Property one, you're making about 74K. Now, it doesn't sound like a massive difference, right? But property one is about 23% worse than property two, right? And that's in just 3 years. As time goes on and that continues to compound and compound and compound, property two is going to continue to outstrip property one by a significant margin, right? And property two, that 91K probably is actually enough to get them towards their second one, right? Or if not, they are so damn close. But the property one people, they're probably still at least another year or two away at best before they're there. So suddenly, property two is now buying, or investor two is now buying a second property in year three. Investor one isn't buying another property till year 5 or year 6. And you now extrapolate that over multiple purchases, multiple years in the portfolio. And it's like the old super ads, compare the pair, right? One's over here, one's over there.
Yeah, well, how much do you actually think that would slow people down in acquiring properties? Because we all know that acquisition period is the most important part. If we could buy all the properties that we ever needed in our portfolio in the first couple of years, we're obviously going to maximize our time to allow compounding to do its thing and get to where we want to get to a lot sooner. But the reality is we don't have that luxury, right?
We don't. And I think trying to pick how far would it slow them down, I would honestly be like licking my finger and putting it up and seeing which way the wind blows, because I couldn't tell you off the top of my head. But I think if you think about it, investor one in that scenario is almost buying in double the time frame. Like a bit less, but
now you've got multiple properties that are building that equity base as opposed to just relying on that cash flow focused asset that doesn't really have the growth prospects behind it as well.
100%. And to me, that sort of solidifies the fact that you can't really, especially in the early stages of your portfolio, no matter what your goals are, you still need a balance between the two, because while, yep, that person wasn't out of pocket any money, keep in mind, again, like we keep reiterating it, but the current interest rate environment, whilst they weren't out of pocket any money, they're also now going to be out of pocket additional properties for quite a bit longer. And that's going to be a lot more detrimental. And if you think, like, if you're dropping, 9K, 10K a year on a property just to hold it, when you take that over the course of 52 weeks, it's not actually that much money, And like, if that's where we're at right now because of where rates are at, and that's the biggest driver, right? If you shave 1% to 2% off, that property that's losing that 8 to 10K is now, maybe shifting back to positive, or if not, you're only maybe like 1 to 2K over 52 weeks out of pocket. It's effectively neutral, right?
Yeah.
Like, to hold an asset that is growing and doing all that for a very minimal output. We're not talking about going and buying some blue chip property somewhere that you're out of pocket 40 grand a year, 50 grand a year, which is true. There was an article that came out in the AFR earlier this year that showed, some of the suburbs around Sydney and what their losses are. Some of them are literally a good chunk that you'd think of like as blue chip is literally like 50, 60 grand a year. But I think, getting back to the point, time, right? It just lets you leverage faster, all by thinking about how your goals pull into this and building a plan around that.
Yeah. And I guess, what do you think about those investors that are kind of wanting to, take that little bit of a shortcut? Like, if we can get to that goal, that cash flow goal, a little bit sooner, like, isn't that going to really put me in a really good spot? And that's where I think people can get attracted to those really shiny objects, those new to market kind of opportunities.
Yeah.
Things like, your NDISs of the world, your co-living kind of assets.
Yeah.
So what's your stance on that in trying to make it, take a bit of a shortcut?
What's my stance? Yeah. I think my stance is, again, it gets back to the whole crux of this conversation, which is you need to understand your why, you need to understand what your goals are, and then you also need to understand the path that you're going to take to get there. Because, I don't think I will ever say that there is one type of asset that you should never buy regardless.
Yeah.
But I will say that a lot of those types of shiny assets that you're talking about and things like that, they may not have if they have a place, it may not be a place until much further in your portfolio, right? So I'll tell you, like, for example, NDIS housing, right, they go and advertise what happens if you go and get every room in their house filled, you get top market rent and everything's in there, which isn't a guarantee that any of that stuff can happen, let alone all of it. Then B, it's specialist accommodation. Banks hate valuing it because it's specialist accommodation. If they had to sell it because you defaulted, it's a lot harder. It's only going to a unique type of person that can, like, investor or somebody that obviously needs it for their needs. So because of that as well, like, property prices are ultimately supply and demand. The demand for an asset like that is always going to be reduced.
Well, it lacks utility, right? It appeals to that specific rental market, which is the disability sector.
Exactly right. So your future growth prospects, I'm not saying that they're zero, but they're going to be heavily reduced compared to something else. So again, what's my position on it? I think that those types of shiny assets may have a place, but the may is probably not going to be anywhere near the start, and it's probably going to be right at the very, very end. And even then, personally, if you go and look at any of the people who've made significant wealth in property, most of them have done it through very boring investment, not exciting, thrilling, like unique type stuff, because often it's a fad or a phase or something like that.
Yeah, it was interesting. We had a client the other day that came to us and they pretty much wanted to restructure their portfolio. They had multiple NDIS properties that they purchased somewhere in Queensland where there was just way too much supply of these NDIS properties. And you got to put yourself in the shoes of the disabled, participant, right? If they've got the option to go into a house completely unoccupied, it's just themselves, as opposed to sharing with somebody else, they're going to pick that, right? And he just found that he couldn't get those participants in his property.
Really?
And he was just bleeding money and he couldn't sell it.
Yeah. Well, of course. It's because, again, it's so niche. It's such a specific asset. Right. And I think, you said something. It made me, I had something really good to say and it's now slipped my mind that's what it was. And it was a lot of, I don't want to digress off the point of today, which are all around goals and setting yourself up and everything. But a lot of the companies that do that type of thing, like the NDIS or other things like that, one of the biggest things you see with NDIS is they spruik about how there's an absolute lack of accommodation for people that need it and things like that, people with disabilities that would be eligible and things like that. But what they never talk to you very heavily about is often, like, overall, that's true, right? If you talk about Australia, that's true. But it doesn't mean in your area there is this abundance of need
Yeah.
that is then going to be filled, right? And then suddenly you go in there and there's 50 or 60 or 70 of these houses getting built across, the broader geographic area.
Yeah.
And there might be 30 or 40 people waiting, but like it's not this abundance. They say in Australia, we're short. I'm picking a random number here, right? But they go, oh, we're short, 50% of the housing we need for people that require it and stuff like that. So due diligence, an episode we're going to do very shortly, but due diligence, so important. But mate, before we finish up, I think one thing I thought would be really good for you to put out to everyone. What are some things that people can think about, some questions maybe that they can pose to themselves about everything we've spoken about today?
Yeah. Well, I think probably the first question for people to ask themselves is, what is it that you want to achieve and what's important to you right now? Right. And that's, is it the cash flow side of things? Is it the growth side? Do you want to set yourself up so you can get into that next property a lot sooner? Right. I think that's probably question number one. Question number two, based on your scenario, based on your financial position, what do you think is a realistic number of purchases for you over the next 5 years?
Yeah. And you know what? I really like that question because I think it really plays into that shorter and middle term outlook, which is that over the next 5 years, for a lot of people, they might be able to tangibly achieve 2 to 3 purchases. But it really gets you thinking because time is the most critical component. And if you can compress your purchasing time horizon over 10, 15, 20 years, that has monumental differences between going, oh, I'll buy one now, I'll buy another one in 4 years, I'll buy another one in 8 years.
Yeah.
Categorically different.
I'd be curious to know how many of our listeners today have so much equity just sitting in their property that they don't even know that they can tap into.
I bet significant amounts of people, right? And it's a good. I don't think that was actually one of your questions you were going to pose, but I think it is a great question to think about because I reckon upwards of 50% of our clients would be that type of person who they bought a family home, haven't really thought too much about investing. For a lot of times, either they don't have the time or they also just don't know how to go about it, so it just gets pushed to the side. And they could be sitting on hundreds and hundreds of thousands of dollars of equity. So whilst they might be a little bit out of pocket when they go and buy a property with all equity down the road, all borrowed funds, and then the deposit comes from equity, they've got the ability to obviously withstand that and be fine. And yet now they've suddenly got an asset pool that's growing. So anyway, sorry.
Yeah.
These are your questions.
No, that's okay. And I think the final kind of question that I think people should be asking themselves is, what kind of risk tolerance do you think you have as well, right? Because at the end of the day, it's an investment and you're inherently taking on a level of risk, right? So I think you need to be comfortable with being able to pull the trigger, right? And executing on a purchase and wanting to do better and kind of, further your financial position, right? So risk is a component that I think a lot of people don't understand and speak about too much. What's your thoughts on that?
I couldn't agree more with you. I think that for what is good for one person, what is palatable for one person might not be for someone else. And just because you've got the capacity to go and buy 5 properties in 5 years doesn't mean that you're going to be able to sleep at night. And it doesn't mean that you want to do that, And you might go, you know what? The trade-off is I'm going to have a lesser outcome in 15 or 20 years, but that lesser outcome is still more than satisfactory to me, right? More than satisfactory. I'm not here to, be a real estate mogul or something like that. I'm here to set myself up, and I can do that. But then other people, they might have huge goals, which necessitates buying something a lot really quickly, or they might just, they just might love it. And their risk profile is different. So I couldn't agree with you more.
All right, mate. Well, we're coming to the back end of the first episode. I think the last piece of the puzzle is, Sorry.
That's right. We'll just do that last bit again. That's right. We'll just call it quits. We'll call it quits here.
Yeah. Oh, you don't want to?
Yeah. No. We'll just leave it for time.
Okay.
That's why I threw the question. Yeah. So I think
Okay.
Yeah. I think just go. So we're coming to the end of the episode. Like, what do you? Yeah.
So I guess coming to the end of the episode, that's a bit of a wrap for us. I think today's all about, why setting those clear goals is key. Every decision, every property, every dollar invested should reflect those goals. If you're unsure about starting, sorry.
It's all right.
Start again.
That's all right. Do it again.
Yeah. So I guess to wrap up our first episode, today is really all about, setting those clear goals. Every decision, fucking hell, sorry.
Don't read off, just talk. Just talk, man. Don't stress about it. Just talk.
Yeah.
Trust me, don't read it because you'll fuck it up and the point is just to wrap up, say a couple of things, throw it back over to me.
Yeah, okay.
Just don't overthink it. Don't overthink it.
Okay. So to wrap up, guys, first episode today, really all about, setting those really clear goals. Is there anything else that you kind of want to add to the mix before we close off?
Oh man, I could sit here for ages. I feel like this episode went even longer than you or I really intended it or wanted it to go. But no, I think on my end, having built, I couldn't even tell you how many portfolio plans for clients, then executed on those plans for clients. Obviously, as an investor myself, breaking down, understanding the market and things like that. I think the biggest thing that I would just say to everybody is, if you don't know how to do some of this goal setting, if you don't know where you want to be, or you don't know what is maybe even possible for you, right? Because we talked about one of the early steps is thinking about like your situation and also what your timeline targets would be. If you can think through all that, great. Set it up, do that, and either execute yourself or get some help, right? But if you don't know how to do that, that's also okay. That is more than fine. And that's where, you can come and have a chat with us at Atlas. You can have a chat with Luke. You can have a chat with me. You can have a chat with some of our other team members, and we can help you do that, and then obviously help you execute on it. So I think just to finish up for today, guys, if you love property or you think you love property, you're either looking to start or build and then scale a portfolio, come and have a chat with myself and the broader team at Atlas Property Group. We'd love to help you. We'd love to help you keep executing on your goals, or help you set them up if you don't know exactly where you want to be with them. And now's a great time, right? Coming into this Christmas period, the best deals happen then. And the people who are ready now, even if they can't get the purchase done before Christmas, coming into the new year, I can tell you, so many people are going to sit back and they're going to go, you know what? I'll just wait. We'll get through January. I probably won't still do anything until Australia Day. If we're at Australia Day, we may as well just wait till February. And then suddenly February, they're going, you know what? We'll try and get everything sorted. We'll go get our pre-approvals. We'll go have a chat with Atlas. We'll do all this stuff. And suddenly, you don't have all the pieces of the puzzle set up to buy until now. It's like March, and then you start looking and markets are tight. Suddenly it's April, June, July that you're actually buying.
I think we're actually in our 21st consecutive month of price growth across Australia. And
there you go.
Does it look like it's slowing down to you?
There you go. So guys, thank you so much for tuning in. Lukey, thanks for jumping in with me. And if you want to come and have a chat with us, jump onto atlaspropertygroup.com.au, put your details in, and one of the team will give you a ring, and we can have a chat about where you are and then where you want to be.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.